The Institute of Fiscal Studies say thousands of pensioners could be worse off if they fail to shift older pots of money and investments into ones offering better value for money. Further research indicates people in their 50s are in schemes with charges that are high compared with current market standards. Let's go to Carl Emmerson. Carl is the Deputy Director for at the Institute of Fiscal Studies. Carl, a lot of people will have glazed over at this stage, quite simply because they have no idea what you're talking about, nor indeed what to do. I mean, obviously it's a very important message and it can cost people money. How can you help them?
So what we did is we looked at some data on people in their 50s who had several pensions. And when you looked at the costs of the pensions they took out in the last 10 years, those charges were pretty low, pretty similar to what you'd get today. But some of the pensions they'd taken out 15, 20, 25, 30 years ago. And those pensions on average had much higher costs. So we're talking about, instead of charging less than 0.75% a year, they were charging well over 1% of the fund each year. And so this matters. It matters particularly because we saw no evidence that those older pensions were delivering better returns. So people were paying more for something which wasn't delivering them more income. You ask what they can do about it. Well, what they need to do really is to engage with their pension, potentially take some financial advice and consider moving it to a provider where the charges can be lower, more in line with the levels that you get if you open up a pension today.
So these things may have been taken out a good few years ago. They might be gone, but you certainly shouldn't forget them. It's like a spring clean, is it, for your pension?
I think that's exactly right. And it wasn't just the charges which were high. It was also the case that it didn't look like the funds were being invested as well relative to people's current preferences. So again, pensions taken out more recently. If you told a provider you were quite cautious about your investments, they were invested in a relatively cautious way. If you told them you were more perhaps adventurous, they were invested in a more aggressive way. But if you looked at the pensions that have been taken out a long while ago, it was less likely to be invested in a way which matched what your preferences are now. So as well as getting lower costs, people who look at their past pensions, who do decide to move them, when they're thinking then about how to invest the money in that pot, it's more likely to be aligned with what they want today, which might not be the same as what they wanted when they talked to their pension company perhaps 25 years ago.
And does this have more repercussions the older you are, the closer you are to pension age?
I think it's particularly important for people in their 50s for two reasons. One, they're people who are more likely to have substantial sums squirreled away. If you're in your 20s and you've got a badly invested pension, it's less likely to have a big amount in it. I think the other issue is that some of these pensions, because they were invested a long while ago, it was under previous regulation regimes. It was before, for example, stakeholder pensions came along in the early 2000s in some cases. So it's those older regimes where actually charges were allowed to be higher, and that's what we're seeing as a legacy effect. You see governments come along, they introduce new rules for new pensions, but they don't change them for existing ones.
We look at how volatile the world is, how volatile the world markets are, gas and oil prices and situations like Ukraine going on. Is the world still a good place for investing in?
Well, the alternative to making investments in companies, of course, is to hold something very, very safe. And those are the assets where the returns have particularly looked bad over the last, since sort of a month into the pandemic. And certainly if you're holding, for example, cash at the moment, you're seeing pretty high inflation eroding the value of that. So you've got to choose a balanced approach. And I think that's another reason why you want to engage with your pension. If the world changes a lot, it's more important that you engage a little bit more often with your pension. Obviously not every day, but once you've been through big shocks, it might be another good time to have that spring clean.
Yeah, have that spring clean, dust down that pension, see what your penalties are, what you're paying, what your investment rates are, and go seek the advice of a professional. You were listening to Carl Emmerson. Carl is from the Institute for Fiscal Studies. Thank you very much indeed for your time, Carl. Thank you.
Thank you.